Good afternoon and welcome to the MATTIOLI Woods PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Michael Wright, Group MD. Good afternoon to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us this afternoon. Against the backdrop of what was a very difficult macroeconomic period to the 30th of November 2022, we are pleased to be reporting a positive set of interim results. As we'll come on to in the presentation, the need for advice has never been greater. Therefore, as a business that offers holistic financial planning, supported by in-house offerings such as administration, investment planning, and specialist products, the opportunity for us to grow and develop is significant. But it is only achievable as we have the capacity. Core to our culture is putting the clients at the heart of all we do. And core to retaining our culture is training and developing people across the group. So we now have 184 fee generating consultants. Because we train them ourselves, a large number of these individuals are only just starting their careers and therefore can win and nurture new relationships to take advantage of this opportunity. Today, we're going to talk about how we've performed over the last 6 months. And I'll pass to Ravi in a second to talk through this part of the presentation. We'll then return to myself to look at how we can capitalize on the opportunities over the next 6, 12, 18 months and beyond. So now pass over to Ravi to talk about the highlights, and I'll speak to you again shortly. Thank you.
Thanks very much, Michael, and good afternoon to you all. It's always a pleasure to talk to those of you who know the business well, and for those of you that don't know the business so well yet, talk to you about what we do and why we're proud of the business that we're creating at the moment. So if we start by taking a look at what we're calling the highlights of the first half of this year, starting with revenue, we generated £54.9 million worth of revenue, which is a £5 million increase on the same period in the prior year, an increase of 10%. And to put that into context, that £54.9 million of revenue that we generated in the first 6 months of this year represents 94% of the total revenue in the financial year and ending 31st of May 2020. So 2.5 years later, we've delivered 94% of that revenue within 6 months. Such has been the size of our growth over the last 2.5 years. The pleasing feature of the revenue growth, as I'll come on to talk about, is that within that organic revenue growth was 2.2%. And a key feature of our revenue model is high recurring revenues of just under 90% at 89.6% this 6 months, which was a 2% increase on the same period last year. EBITDA was 15 million, slightly down on the prior year, and I'll come to talk to the reasons for that shortly when I go through the financial slides. Likewise, from a margin perspective, it was still a healthy 27.3%, but that was down on the prior year, and again I'll talk to that in a short while. From a profit before tax perspective, the statutory measure that was often talked about in news articles or in the press, that went up 45%. And in particular, the contribution from our acquired businesses to that revenue growth was just over £3 million. From a financial stability perspective, our cash generated from operations was a positive 7.2 million. And at the end of the period, we finished with a cash balance of just over £38 million at 38.3 million. that we can choose to deploy into investment into the business or investment in further acquisitions. And finally, from a regulatory perspective, regulatory capital perspective, our surplus was a very healthy 176% on the requirements for regulatory capital. So from a financial standing, we remain in a strong position. If we then look at some of our commercial metrics, how we measure the business, total client assets were 14.6 billion at the end of November. That is a 2% reduction within the period. And given the market context, we are pleased with that 2%. And again, we'll talk to reasons for that reduction. We won 490 new client mandates in the first half of the year. That is down on the prior period. But if you look there, the key thing for us is that whilst the count was down, the value of those clients was significantly higher. From a net flows, we reported positive 38.1 million of net inflows, and that is after having paid out 88 million pounds worth of benefits to pension clients, and nothing more gives us more pleasure as a business that started in pensions advice to pay out 88 million pounds to clients for them to enjoy their pension and to enjoy their retirement. Within the business, we now have 184 fee-generating consultants. We've continued to invest in capacity. We've continued to invest in training and mentoring, and we're continuing to grow that portfolio of advisors, both now and into future periods. And the final elements, from an earnings per share perspective, basic EPS was up 68% to 5.9p. Adjusted EPS was 21.2. And we propose a final dividend, given our confidence, an interim dividend, I should say, given our confidence in the rest of this financial year and for future periods, we're pleased to increase that interim dividend by 6% to 8.8 pence. So with having looked at the highlights, we delve slightly deeper into the financial results. We'll start with revenue and move on to cost, and then ultimately look at adjusted EBITDA margin. So our revenue performance was pleasing in the first half of the year for a number of reasons. But if you look visually on the left-hand side of that chart there, every segment of our business grew. That 5 million increase was driven by both organic revenue growth and also acquired revenue growth. And if we look at the split in between those two, if we include organic growth within acquired businesses, we delivered 1.3 million pounds worth of increased revenue purely through organic means. And as a business that is focused on advice and focused on organic growth, that is a very pleasing feature for us. In addition, the lion's share of the growth came through the impact of acquisitions over the last 2 years. And in those last 2 years, we've acquired 9 businesses. So we're seeing a number of things here, part of which is annualization impacts of those businesses now representing a full 6 months worth of trading in this period, but also the growth within those businesses since acquisition or since joining the MATTIOLI Woods Group. And the acquired growth represented the balance of 3.7 million pounds. We often talk about our strong, resilient revenue model, and by that we mean we have fulcrums within the business such that revenue can be maintained in both good and bad markets or challenging markets. Taking those in turn, that first segment in the top left graph, our investment and asset management segment grew primarily through the impact of acquisitions, but within that we saw asset values go down by 2%, and therefore the revenues linked direct to asset values fell. But on the flip side, in challenging markets, we're able to engage with our clients far more. Uncertainty creates a higher demand for advice. And given the client engagement program that Michael will talk to later, we saw an increase in pensions advice and administration by just over £1 million in the 6 months. And then equally, we saw the impact of performance in both the property management and employee benefits segments also increase. And we've often spoken in the past about our Maven acquisition that happened 18 months ago. And that business continues to go from success to success and delivered an additional £1.7 million worth of income in the period. But we did see a slight shift in mix of that business. Last year, we were talking about performance and exit fees. In this period, we're talking about the next cycle of investment and a higher number of deal arrangement fees as the exit monies are redeployed into new investments. So effectively, we see the next cycle of investments taking place. We also have a number of exits that are in process now. We have just under half a dozen processes that are ongoing. But given where the market is, given the level of confidence, what we have seen as a feature for the last 12 months now is that fundraising and exiting of deals is taking slightly longer. And therefore, some of the exits that we'd planned for this year could well fall into the next financial year. It's a question of when rather than if. Within that revenue mix, we continue to enjoy high recurring revenues of 89.6%. Now that gives us great comfort and something we are proud of as a business because it gives line of sight for future revenues and future maintenance of performance, but also it's an increasing metric year on year, which means that we're having a more established longer term relationships with our clients. Moving on to EBITDA, in the first half of the year, we saw EBITDA move from 15.8 million to 15 million exactly at the end of November. And you see in that bridge there are a number of features, but effectively there's a revenue increase that we've talked about, but then there's two specific investments, both in, or I should say individually in capacity in our team, in our employee benefits expense. And there's an investment in efficiency and the underlying business, primarily investment into technology. If I talk through each of those in turn then, taking them in that order, our investment in capacity was driven by changes made to remuneration structures for the existing team and to recruitment of new members to the team. So within the existing team, at the beginning of the year, given some of the cost of living pressures that we've predicted, that we're experiencing now, and we expect to continue into the future, we gave all members of the team a 3% cost of living bonus that was paid in July, so at the start of our financial year. In addition to that, we awarded broadly a 2% wage increase or a pay award to staff across the group. That ranged between 0 to around 8%, but broadly it was a 2% increase. And then we expect to pay a discretionary bonus at the end of this financial year, in the second half of this year, so that staff on average take at least a 6 to a 10% increase over the financial year ending May 23. In addition, we continue to recruit. It'd be very easy for us to say in challenging markets, don't recruit, don't train, don't bring in new staff. But as you'll hear shortly from Michael, recruitment is essential to who we are and what we do, and in building capacity for future growth. If I then move on to, so that's investment in capacity. Investment in efficiency relates primarily to investment in technology. As a business, we're looking to streamline our administration processes, to streamline our interaction with clients, to deliver a better client service and a better client experience as one of with the Mattioli Woods clients. The way we'll do that is to invest in a wealth management, effectively an administration platform, to sit alongside our proprietary MWeb system, which will be our core pensions administration software. So our SIP and our SaaS book will sit on MWeb. Coupled with that, we'll have a third-party provided CRM system or a wealth management platform, which will look after all of our core client detail and which will be the focal point for our administration processes. What we plan to do is work with a third party to license their software rather than developing it ourselves, which we believe will be both risky and costly. And there's the debate around when that's delivered and what is delivered. We'll work with a third party to license their platform. We'll bring on the more recently acquired businesses to that platform. One, given the size and due to less risk in moving those acquired businesses onto that platform. We'll take the learnings from those integrations and then apply that to the core Mattioli Woods group and move then the core data set onto the platform. We expect that process will take around 24 months to deliver, and the output of that will be a planned increase in efficiency of between 5 to 10% for our administration processes. And then we create capacity within our administration team to support future growth of the group rather than need to go out and employ additional members of staff where we don't need to. We have capacity in the group that we can redeploy to support that growth. That additional spend is just under £1 million we expect this year. And in the past, we've guided towards an increased investment in technology of around £2 to £4 million a year. We expect to come in within that guidance at the lower end of around £2 million a year. So in this financial year, we expect it to be around £1.5 million, increasing next year to that £2 million as we go fully into the implementation period. And then after 24 months, it will change from a consultancy and implementation cost of £2 million to an ongoing license arrangement at just under £2 million. So we're comfortable with the level of spend that has been indicated to the market previously. And importantly, we've built in contingency to that spend as well. So from a margin perspective, in one of the highlights, I mentioned the 27% margin. We expect that to trend back towards the previous guidance of 30% margin, which is where we're comfortable to declare a margin of 30%. But that will be incremental, one, through a change in mix of revenue, but then increased efficiency within our administration processes to get us to that 30% over the next number of years. If we turn briefly to cash flow or cash, I should say, we have £38.3 million worth of cash at the end of the period. There was a decrease from the start of the period at just under £54 million. And the two main moves there were around £10.1 million was paid out in deferred consideration for previous acquisitions. 10.1 million was the maximum we expected to pay, and we have paid in the first 6 months. Likewise, we expect to pay full consideration in the second half of the year for those acquisitions that are going through an earn-out period. And we maintain that track record of buying businesses, integrating them well, and paying out based on targets what we expected to do. So we're delivering on those commitments as well. And the second element there is that final block of £9.1 million was paid out as year-end dividend for the last financial year. We remain a cash generative business. We have seen earnings enhancement in the period at a basic level. Earnings at an adjusted EPS level is at 21.2 pence. And given our confidence in the performance in this financial year and in future periods, we are pleased to propose a higher interim dividend of 8.88 pence per share, an increase of 6% on the prior year. And we maintain a progressive policy. Michael and I and the rest of the executive team acknowledge our responsibilities to stakeholders in the business, of which staff are key, of which clients are at the foremost of that. But equally, we respect our responsibility to shareholders and the need to pay a progressive dividend. And as an example of that, over the last 8 years, our compound growth has been just over 12% at 12.5 pence growth. And we expect to maintain a progressive dividend for the future which remains well covered at 2.4 times adjusted EPS. So with that, I'll hand you back to Michael to talk about the group and our strategy.
Thank you, Ravi. As I mentioned at outset, one of the great strengths of this business is our advice-led, responsibly integrated model, incorporating both solutions and products, all designed to achieve great client outcomes. In this very challenging macroeconomic climate, the commercial advantage to Mattioli Woods is that we can wear many hats for the same client, managing more of the value chain. For clients, this means they receive the same, if not a better end result, whilst gaining economies of scale. And as we'll come on to, it is also naturally synergy promoting within our acquisitions. However, we are aware there is an element of complexity in this model. And so over our next presentations, starting today, we are looking to represent our service lines to better demonstrate each of these commercials. So we'll cut the numbers today to look at advice, pension and trust administration, and investment planning. Then within investment planning, we will consider in more detail where we are the product owner. So in this instance, the premium investments of Maven, and also the property holdings within Custodian Property Income REIT. So looking at financial planning first, we believe wealth management starts with advice. Of the £14.6 billion of assets, a Mattioli Woods consultant is offering advice or financial planning on 9.2 billion of them. Owning that client relationship is so important, and we'll come on to why as we progress with the presentation. But key is that we still have, as I mentioned, huge capacity in our advisory team. And as Ravi has just discussed, we continue to win new inquiries and new client mandates. We also offer advice to corporates, and 1.4 billion of our 14.6 billion of assets relate to employee benefit mandates. The assets here are not the key driver, as typically there will be a fixed cost contract within the mandate to the employer. Albeit these mandates can be complex and so significant in monetary terms. Importantly, within the employee benefits division as well, we continue to win new clients. With pensions and trusts, we administer 7.1 billion pounds of our assets. On around 5 billion of this, Mattioli Woods also offer the advice, with 2 billion relating to other financial advisors. With fewer companies engaging with this service line, we have a real opportunity to win new mandates for both. Turning to the black and lime green circles on the right, of our 9.2 billion pounds of assets under advice, we have over 3.1 billion in our own discretionary managed solutions, both multi-asset solutions and also property. And we'll look at these separately in a few slides' time. Again, we are offering two service lines here to the same client and on the same asset, as well as also being a route to market. This means these are highly profitable whilst getting a great outcome for the client and also highly scalable. Lastly, if we look at the private equity circle in the at the bottom there in the blue, and also the Amati circle, these are our premium investment solutions, and they are an incredible success story in their own right, with the ability to charge much higher yields due to the specialist nature of what they're offering. The opportunity here remains utilizing more of these solutions in the existing advisory relationships, particularly with Maven, who are developing solutions specifically for our clients. And again, we will come on to this through the presentation. The key point here is that as a business with £14.6 billion of assets, but by adding up all of these circles, the value of these assets is equivalent to 22.5 billion and can become higher still as more and more of our clients use more than what we do. If we move through the presentation now and consider advice. For an aging population, the need for advice has never been greater. Fewer and fewer people have their retirement underpinned by final salary schemes. So financial independence has to be self-determined. Couple this to the concerns of rising inflation and falling asset values, and clients are focused on their own wealth like never before. As a business that trains and develops people, creating, as I mentioned, huge levels of capacity in its advisory team, we are very well placed to take advantage of this opportunity. That said, clients are very concerned at the moment. The cost of living crisis is making clients think twice, if not 3 times, before making substantial decisions. So from our perspective, we have seen an element of hesitation across our target demographic, best represented in lower or perhaps slower conversions of inquiries. This is very similar to what we saw as a business in the second half of 2020, as demonstrated in the bottom graph. But because we are an advice-led business who stay so close to our existing clients, we very typically see a return to very high conversion levels as markets calm. In this challenging environment, to have secured nearly 500 new clients with a higher average case size, whilst also generating more inquiries, is something we are immensely proud of and something that puts us very well placed for the forthcoming years. Turning to the 2 graphs at the top, which some of you who have come on before may well be familiar with. We have always believed training and developing our own advisors is essential. At risk of repeating myself, it builds organic growth for tomorrow and protects and reinforces our strong client-first culture. The average age of a MATTIOLI Woods consultant, because we train and develop people, is 42 years old. Compare this to the market, where the average age is 61. This not only speaks to our longevity, but also aids the transgenerational transfer of the trusted advisor relationship. I might advise the parents of the family, but my former trainee, now experienced in his own right, might then advise their children. Hence our very high client retention rate, even on the sad death of key client relationships. This graph also illustrates the untapped potential we have in the business when we consider the transition of advisors from the left-hand side to the right. Very typically, we see advisors in the marketplace will command a turnover of up to £250,000 to £500,000, which is the middle column of that top left graph. However, the client's total cost will be much higher than this. It's just the advisor will only be capturing one segment of the revenue. Via our integrated model, we capture more of the value chain. And as seen in the graph, our advisors' turnovers are several times higher. Indeed, we have some advisors in the business whose turnovers were as high as £2 million, whilst always providing great client outcomes. Whilst not identical, the position is similar for EB fee earning consultants with higher consultant turnovers than the marketplace. And importantly, the EB business has been the origins of a significant number of new clients for the wealth management team, which will continue. One point to note on this slide in particular is the business has changed following the recent acquisitions. We now have more fee earners than just those that sit solely within the wealth management or EB world. So we will likely redesign this slide over the next 6 to 12 months to better represent other parts of the business, most notably the Maven deal makers. Turning to administration. Whilst relationships typically begin with advice, they are supported by the highest quality administration, meaning clients get the best service. Let's not forget our consultants offer advice on 3 billion of the pension and trust assets that aren't invested wealth, most notably transacting on commercial property that the client may have already owned or owned in their business or are looking to acquire to expand their business. This simply isn't an option for the other wealth managers and financial advisors, meaning our advisors have many more routes to market. As with all firms, we remain focused on simplifying our processes and implementing new technology to drive efficiency through this area of the business, which Ravi mentioned a few moments ago. When we came to market, the average administrator could look after 40 clients. But the work we've already done means this number is now nearly 75, and we expect this to increase. With over 11,000 SIP and SAS in the business, there remains a key opportunity with our banking facilities across these portfolios to both elevate the interest clients are receiving on their current accounts and also garner additional revenue for the business. We are now in the process of transitioning our SIPs to externally addressable virtual accounts, which is more efficient as an operating model, so clients will likely see reductions in costs by some degree, but also via this centralized facility, we can generate a better level of income for all parties. Finally, administration remains a great training and development ground for so many other elements of the business. A significant number of our advisors, myself included, were previously administrators in the business. For me, this slide speaks to the power of an advice-led integrated model offering investment solutions. Where we own the client relationship, we continue to be the custodian of the wealth, even in very difficult markets. The outflows across the advised group are no more than the benefit we have paid out to clients over the last 6 months. And whilst that isn't an exact science, paying benefits to clients is something we're always really, really pleased to do. But where we don't own the client relationship, for instance, a Marty, then outflows can be more pronounced in downturns. That said, Amati have been a huge success story for us, starting at just under £100 million of assets when we first met them, to now being worth over £1 billion. So as a business with huge capacity in the advisory team and core investment solutions in-house, we'd expect a strong uplift over the next period, both through new client mandates, but also as the acquired advisors use more of our in-house discretionary services. Moving across to our premium investments. This slide aims to explain the rationale for why we acquired Maven. There will likely be further pressure on the revenue of traditional investment managers, with mainstream funds continuing to consolidate and reflect a lower charge to the client. However, specialist investment, with all the benefits that brings, will carry a premium into the long term. Furthermore, to offer clients a truly diversified solution within appropriate risk tolerances, off-market investments are key. As so many listed entities go private, we need optionality in this space. Clearly, this is cyclical, but it highlights the need to be able to have credible and diverse solutions. Over the last 6 months, we have been able to integrate the existing Private Investors Club into Maven, and as reported, have co-launched 2 property deals. Our clients have gained the opportunity to get even more attractive returns from the expertise that Maven bring. And as a business, we now have appropriate performance fees and carries, enhancing the commercials. It is here we still believe we have the most untapped potential. Whilst we're still early in the journey with Maven, the ability to marry up our distribution with their offering is something we've only started to benefit from. A good example of this is where we have co-created a PE fund, so we can incorporate, where appropriate, the Maven PE offering into our pension estate. The first of these milestone funds is now open, and after only a few weeks, we have raised over £2 million. Indeed, we get real leverage when new businesses who join the group then broaden their own range. So it is really pleasing to see that Ludlow, the business we acquired approximately 18 months ago, have invested £2 million into the recent Maven VCT launch. Finally, on the segmental analysis, we look at property. We have, since the origins of the business, been big believers in the synergy of commercial property and pension planning. And whilst we manage 500 million of property through the custodian REIT, let's not forget we also look after a further £2 billion within pension schemes. We have developed a huge amount of expertise and ancillary value through this revenue line. The recently renamed custodian REIT not only generates revenue for property management, but we also generate revenue through our group insurance policy, providing clients with the most appropriate cover, but gaining the economies of scale for all concerned. We continue with the existing property picks through custodian capital, which remain a core part of a number of our portfolios, noting, as I mentioned, that this will shift across to Maven as we scale this offering for the future. And this is what we're really excited about: the option to create further investments utilizing co-expertise of Maven and MATTIOLI Woods, blending expertise and distribution. It's very powerful. Turning now to our ESG policy. The concept of ESG, before it became known as such, was already an extremely important component of the business. Our MW ESG committee continues to ensure that this remains front and foremost in our thinking. We're very conscious of our carbon footprint. We amalgamate offices wherever through acquisition we end up having more than 2 properties in the same location, something we've done very successfully in London. Our own office in Leicester was built with energy efficiency in mind, and the CREET runs a strict ESG policy across the whole portfolio. Through our own ownership of Amati, we continue to make significant annual donations to charities, not to mention the founders of MATTIOLI Woods, as well as those businesses we have acquired, have either set up charitable foundations or make significant charitable donations in their own right. As a business that originated in Leicester, we have always been and remain a diverse employer, whether this is gender, race, religion, or any other aspect of life. We consider this a huge advantage, as this means we can empathize with people from all different backgrounds and win new clients from all communities and sections of society. Finally, good governance is key to advising clients. As a business trusted to look after other people's money, it is essential we are structured to operate appropriately. As a business, not all of the UN's 17 Sustainable Development Goals are as relevant to us as others. So we are focusing where we feel we can have the most impact, and will report on this accordingly. Moving on now to our strategy and goals. If we step back from the results momentarily, over the last 6 months, we have continued to bed in and develop scale, distribution, and product, all of which we've built up over the last 30 plus years of doing business. Over the last few months, we have further developed our client engagement strategy, ensuring we are as close to our clients now as we have ever been. And although there is an element of hesitation around client investment, which is very natural for this part of the cycle, history has taught us doing the right thing for the client in these challenging periods yields a significant increase in new client wins and the onboarding of investable wealth in the periods that follow. This gives us real confidence, particularly as we continue to gain a greater share of wallet by offering more and more solutions that the clients need. It is for this reason we believe the goals we have set out are highly achievable in the medium term. We know there are several million people in the UK who could use our services, and currently we only have a fraction of this. Now, some are serviced by our competitors, but again, only a fraction. So that leaves a huge amount of opportunity. As a team with real ambition, as a group with 870 employees, and all the talent that brings, we want this business to grow in a responsible and sustainable way. The only way to achieve this is to bring on new clients, which in turn grow the client assets to 30 billion. If through all of the solutions we offer, we retain 1% of the value chain whilst giving clients a great outcome, we will generate £300 million of turnover, and a business of that scale should be working towards a 30% margin. We know to bring on new clients, we need more advisors. As we've said, we grow organically through training our own advisors, and we also bring together other great advisory businesses. Looking at the turnover target from this vantage point, we know by increasing the number of advisors to a team of 250 to 300, each using more and more of the proposition, they will be able to generate on average £1 million to £1.25 million of turnover. We demonstrated that a few slides ago. Ensuring we achieve £300 million of turnover, and again through the efficiencies we continue to introduce, generate up to £100 million of profit. For the business to achieve these targets by organic growth alone would take some time. Equally, we could do a very large acquisition or merger and get there tomorrow. Whilst we are all ambitious, we are also very proud of what we have built. So when we buy businesses, we only ever buy well. We've completed 33 successful acquisitions. And there are good businesses out there for us to consider. And no doubt, successful M&A will continue to feature, albeit most importantly, we aren't dependent on it. For we know we will achieve these targets regardless. Well, thank you everyone for listening to us today. Hopefully we've outlined the investment case for the business, and some of our key summarizing points are there. But can we perhaps pass over for any questions?
Perfect. Of course, Michael, Ravi, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboards. As you can see, we received a number of questions throughout today's presentation, and I'll start with the first one here, which is around acquisitions, and asks, what's the appetite for further acquisitions?
Yeah, I mean, perhaps if I start that one, I think we've got real appetite for furthering the business via acquisition, as long as we bring together the right culturally aligned businesses. Now, I'll pass over to Ravi in a second. I mean, one of the challenges right now is pricing, but because we've got capacity within the business, we can actually do a range of different types of acquisitions. And one acquisition that we can do is actually assist retiring IFAs to retire, because we've got the capacity to take on their clients. So we've got big ambitions for M&A done appropriately, but while pricing's a little bit hot, we can change the nature of the M&A we do. Do you want to comment at all on pricing in general, Ravi?
There, pricing has been something that we've seen accrete over the last 12 to 24 months in particular. The reason for that is in the wealth management and IFA sector, we can see sight of around just over 30 consolidators who are active in this market. If you combine that with the number of businesses akin to a Mattioli Woods, akin to the number of our peers, that pool is around 40 different organizations who are effectively going for the same types of businesses on a larger or smaller scale. And what is often the case then, when you have consolidators in particular, the main lever that they have to play with is price. So because they are building a network or a foundation of a business through acquisition, they are very keen to bring in scale. They're very keen to bring in expertise and product. Therefore, the pricing we've seen has accreted over time. Typically, certainly when I was looking at M&A on a daily basis in previous roles, the rule of thumb was broadly 6 to 8 times EBITDA would be a multiplier that you could use to price. Where we've seen that go over the last couple of years has grown to 8 times, has grown to 10 times, and we're now in a position where the broad rule of thumb is around a 10 to a 12 times EBITDA multiple. We anecdotally did look at a business in the UK that went ultimately to a consolidator for a multiple of 16 times EBITDA, and that was actually an all-cash offer rather than our cash and equity with deferred consideration typical structure. And for a business like Mattioli Woods that is listed, that does have earnings criteria, that does have a strategic rationale for acquisitions, we simply can't justify those levels of pricing. It means a number of things, but 2 of which would be to cut costs dramatically and to push revenue, often at the detriment of clients, neither of which we're prepared to do for most of our acquisitions, given they are people-focused businesses. Because we are a people-focused group, the integration of acquisitions is very important, and maintaining the engagement and support of the team that you acquire, it remains first and foremost for us. So we take a more risk-managed approach. And equally, we don't particularly want to engage in price competitive auctions because it generally means price goes up. Where we do have an advantage is in that small to medium size acquisition, where it's often, as Michael's just said, a retirement sale, which we can facilitate. And because of the fact it's a retirement sale, price remains important. It's one of 2 things that remain very important. The second being the business that acquires the firm needs to be able to look after the clients in the same way as the vendor could, because often it's a lifestyle retirement and the clients are in most cases friends or close associates of the vendor, so they will see one another in future days and weeks, and therefore it has to be a successful sale to a business which continues to look after that client base. Capacity wise, at the present day, we have around 20 or just over 20 million pounds worth of available cash to deploy for acquisitions or to invest back into the core business.
Perfect. Thank you very much. The next question here reads as follows. Pleased to see the increase in dividend. What are your plans moving forward with regards to the dividend, and how you balance this versus investing for growth?
I mean, as a business, we believe that paying a good dividend is good business discipline. It ensures that we balance the needs of all of our stakeholders, from clients, as Ravi mentioned earlier on, through to staff, through to shareholders. So we'll continue to maintain a progressive policy on dividends, and we've increased the dividend by 6%, such as our confidence in the full year position. Equally, we think that the business needs to maintain strong cash flow and retain firepower for future investments. So whilst we'll be progressive, we're always mindful of utilizing some of that money in the business to take the next leap or take the next acquisition.
Perfect. Thank you very much. The next question here asks, you mentioned less client wins, however, the new clients are of higher value to us, which is positive. Is there a process in place that can continue attracting these type of clients?
Where we differentiate ourselves, as I've mentioned a number of times during the presentation, is that we train and develop people. And the second part of that developing is all about mentoring. So our senior advisors via our T&C program are always mentoring the juniors and even some of the seniors as we go through the process. So as more and more people who we've trained recently become more and more confident, they actually naturally attract higher value clients anyway. I also think the introduction of the Maven proposition, which specifically attracts higher value clients with higher attitudes to risk, higher capacities for loss, that type of proposition utilized appropriately does tend to attract, higher net worth clients. So overall, we'd expect to continue to see that to gently rise. But there are opportunities, of course, for smaller clients in accumulation phases. So we don't want to lose sight of that. Being the advisor to someone who you've helped build their wealth is a fantastic way of ensuring a really great long-term relationship. Thank you.
Perfect. Thank you very much for that. Another question here on acquisitions. I know you have touched on acquisitions, but maybe something you might want to highlight. Following the acquisitions, are there further costs that can be taken out as they become fully integrated?
I mean, I think when we price and consider acquisitions, we are very, very mindful of two things. And very typically, someone's built a business that is to use an old expression, their baby. Also, the clients are very much friends and family in some instances. So for us, we are a culture first business who require a long-term plan for most people. So there will be times when a role within a business is no longer required. But what we are exceptionally good at is then redeploying those people across the group, which just simply means for us, we haven't got to recruit as many people in the future. We've already got great people in the business. And it comes back to that responsibly integrated model. Because we do more things, we've got more things for people to consider as career options.
Yeah. I think just to add to what Michael said there, the way we'd integrate a business is often we always start with the client. That client journey, as Michael talked about earlier, what we won't do is rush the integration of a client and simply repaper them and put them into a MATTIOLI Woods typical client investment profile, because it will be inappropriate to do that, but also undoes 20 or 30 years worth of work that the previous advisor has done with that client. What we focus on with integration is typically starts with the client, but then we also look at all of the support services, if you'd call it that go around integrating that business. So functions such as HR, finance, compliance, marketing, those types of functions, very soon in post-acquisition, we go in to ensure that there's a central support for all of those. And typically that means, let's take an example which is very close to myself, with a finance function. Very quickly, within 2 months, the finance function is able to run the accounts and the finance transactional areas for the acquired business, or there's a strong link to do that with a view to bring that into the central group. What that allows us to do then is to streamline and harmonize processes between the acquired and the core MATTIOLI Woods companies. And then over time, they become one and the same process, allowing all staff to operate in the same way. And as Michael's just said there, excuse me, that gives us the opportunity to then redeploy those staff into other roles or to other parts of the business. And as a further stage, what we will do then is look more aggressively at the cost base. So things like dual system running, we'll look to harmonize that system into one, whether that's accounting software or whether that's an administration platform. We'll look to harmonize that into one. As recent examples, in London, we had 3 offices through acquisition. We had the core MATTIOLI Woods office, we had a Hurley Partners office, and we had a Maven office. Very recently, we've signed a new agreement which brings those 3 offices into one location in the city, but at lower cost compared to the sum of the 3 lease arrangements that we had. We'll look to do that relatively aggressively once the client transfer is brought across, or once the service provision has been transferred, such that we do not drop a ball and absolutely we don't drop any client service.
Perfect. That's great. Another question here. How important to the business is your technology to your client offering? What plans do you have?
Yeah, so it's absolutely, technology is very important to us. And if I start from the inside before we get to the client piece first. So there's a number of things that we've done. And, when we talked about the earnings bridge earlier on, I talked about investment in technology. Specifically, what we're looking to do there, which goes to the answer I just gave on acquisition. We're looking to develop 2 core systems for the group. We have a proprietary pensions administration software, which is called MWeb, which we have worked and invested in for the last 30 years since our founding days. And we've continued to invest in that. And we plan to continue investing in the MWeb platform through development of internal resource to make that even more fit and proper for current regulations and future regulations. But we believe that to be a best in breed platform. If you look across the pension administration market, there aren't that many platforms out there, certainly none of which we think are better than MWeb. So we plan to continue investing in that. And we have an in-house development team for a cost of around £800,000 a year that we will continue to develop MWeb. Coupled to that, then, there is a gap both in the market and a need within Mattioli Woods to have a harmonious wealth management, effectively a CRM system that is universal across the whole group. Currently, we have 3 or 4 different systems, and they range from the typical advisor office, IntelliFlow, Transact type platforms that we've seen in the past. And what we're looking to do now is work with a third party to license their platform rather than build it ourselves for higher cost and higher risk, to make that platform kind of ubiquitous across the group, bring in the acquisitions onto that platform, and then move the core Mattioli Woods group. And then from there, as I said earlier on in the presentation, we'll see more efficiency within the group, which helps to increase margin. From a client perspective, we've recently launched a self-investment platform, MWeb, and there's a number of similar platforms out in the market, but we certainly want this to be an opportunity for new clients to join the group, and also an opportunity for existing clients to put small amounts of wealth into a platform that they can invest themselves. If you take Michael and I as an example, we each have young children. And for us to go through the advised route to invest monies in things like junior ISAs will be quite a long process through our typical advised proposition. Michael and I know the affordability, how much we can put into those junior ISAs each year and what the allowances are. So it'd be very easy to use the MWise platform to simply put monies into that on a regular basis or on a one-off basis, having been onboarded, and have a simple platform that I can see my value, my investment at any time. The other element then is a client portal. We're very conscious of the need for a client portal, and we're continuing to develop that. And as part of the wider platform project, we will have a portal at the end of that. But in the meantime, we're developing an in-house portal which will show clients their holdings and their wealth, and provide a firm interface between what they can see live and versus what they see with their advisor. And we'll continue to develop both of those.
Perfect. Thank you very much for that, Ravi. We've got another question here. You mentioned consolidation in the funds market. Is it therefore likely that you will sell off the ownership of Custodian Property Income REIT?
So I think we would probably class the REIT as a core specialism of Mattioli Woods, and I think it's already appropriately priced in terms of where it is right now, given the property development expertise that we have in-house and the property development expertise that we have in Maven. So I think we can protect the yields and the income on the Custodian REIT, and therefore wouldn't look to sell it, and so don't have any plans to sell it. I think probably if you think about the origins of the REIT, and what that actually is a collection of portfolios that we and our clients acquires, that we then brought together into the REIT. It's the right and most appropriate structure to hold those assets within. But our clients bought into the assets in the first place because they have a real affinity for commercial property. So of the REIT itself, Mattioli Woods clients still own nearly 80%, or just over 75 as it is today, % of the asset base. So actually, given that we own 75% of the asset base, given it fits so perfectly alongside the administration fund, the administration we do and the advice that we're offering, actually it sits very well within our stable. We've got no plans to sell.
Perfect. So just maybe one final question. It's quite long. It's got a few parts, but it reads as follows. I see recently the MD of Saga has directed his board to personally purchase and continue to own a multiple of their income in the company shares as a requirement to remain part of the executive incentive package. Is this something that your company would also seriously consider and action as a formal policy of ensuring management commitment? As a shareholder, I would encourage you to look at this as it certainly makes a director remuneration / incentive package more palatable. And then the follow-on question is, accusations can prove negative to the investor. So my question is, would Mattioli Woods ever fund accusation by share issues?
Yeah, that might be acquisitions. I guess there is a lot one. Yeah, I mean, I think it's a two separate questions. What one around acquisitions? I mean, I think the if I will try to answer the first and pass to Ravi more for the second. I think the equity ownership by the executive is something that's really important to us. But we must also remember that the two founders of the business are still within the business. And linked to the second question, we've got a number of key shareholders who sold into us. So Bill Nixon of Maven owns significant Mattioli Woods as part of the deal structure. So Bill, Ian Mattioli, Bob Woods, they're all totally aligned. And we have a significant amount of the shareholding owned by staff or staff associates. As for the executive, we have a policy to target 100% of base remuneration as our minimum shareholding, and we're already working towards that policy. So I think that the question is, whilst we haven't been directed by the MD of Saga, we're certainly aligned to his point that share ownership in the business is the right policy.
And moving on to the question around acquisitions, if I take that word as acquisitions rather than accusations, I think that the question was around, would we fund acquisitions through equity issuance? The typical deal structure does include equity as part of the consideration. Typically, we have a deferred consideration period as well for two reasons, which actually link back to the prior question. It's around ongoing commitment to the group. So the issuance of equity right now, given the share price, would be slightly dilutive, given the fact that when we raised money to fund acquisitions 18 months ago, the issue price was £6.60. So current share price is below that, which has a more dilutive effect on that. We are keen on issuing equity to fund part of the acquisition for two reasons. One is it allows us to balance the cash outflow, the risk reward, and the ongoing engagement of the vendor, the seller, into the group. But it also garners ongoing support for the group. So as a share owner, I'm now interested in the ongoing success of the group rather than my own success. We saw that in the case of a number of the networks, a number of the consolidators, I should say, who issued high values of both cash and consideration. And the turning point for those networks was when it came to paying up the equity element, the value that folks thought they would get was much lower when it came to the actual payout. So they promised a high value and paid out to much lower. And then we saw a number of people leave those networks, and there were big problems. We take pride in issuing equity, paying what we say we're going to pay based on targets. And out of our 33 historic acquisitions, 33 are on track or have paid out full consideration. So we say what we're going to pay, but then there's an ongoing commitment to the success of the group post earnout, and to extract value for the individual and both the group as well. So we would consider it, but with the share price, we would prefer to be higher than the issue price of equity.
Perfect. Michael, Ravi, thank you for that. I think you've actually been very kind with your time there. I think you've addressed all those questions you can from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both and the company, Michael, could I just ask you for a few closing comments?
Yes, no, thank you. I think into loads of them. Really, it's always great to talk to people, even in these sort of virtual forums. It's great to have such debate. So thank you for both the questions. Thank you for your interest, and thank you for your support. As a business, we are cautiously optimistic over the course of the next sort of 12, 24 months, but feel that we've got a real opportunity and the capacity and ability and tools in the toolbox to take advantage of it. So thank you again.
Michael, Ravi, thanks once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Mattioli Woods PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.